Hans Redeker, Morgan Stanley, head of global FX strategy. Hans, as always, thank you so much for coming in. Look, cutting projections from 1.2, which were considered optimistic, to 0.2% for Italy poses a lot of problems. What does it mean for ECB policy?
Well, it certainly means that with the economy weakened, the European Central Bank has all the reason to be as well patient. And I think that the upcoming communication of the European Central Bank may lead us into that direction. But we have as well to see that within a global context. So why is Europe this weak? That has a lot to do with the slowdown we have seen in China, the spillover effects we did see over the course of last year into emerging markets, where you did see that those economies which are especially exposed to tradable goods, that they had been hit hard. So Germany is falling into that category, but the Italian tradable sector is as well huge, and therefore there's an element in here. But in the case of Italy, there was as well a factor which had to do with political confidence. So when the spreads blew out earlier, when Italian government bond yields rose significant relative to the others, that had an impact on local funding conditions. And we see this now materializing in lower economic activity. Now, the big question the market is now going to raise, is it now going to be a technical recession in Germany too, or is it only Italy going to stay in a technical recession? We have actually to look east, and in east, I mean, what is happening to China? China has moved away from what had been regarded in the past as reluctant easing, and then is going into a proactive approach.
Are you telling me that if China gets much worse, actually we could see a resurgence of the euro crisis in Italy?
No, what I'm saying is if China, which we do not believe is getting much worse, we believe that China is actually turning around. And we can talk a little bit more in detail of that. But if China would stay weak, then of course you would have to build in additional growth risk. And we all know the interdependency between economic growth and the sustainability into bond markets. So that is not new. We have experienced that in 11 and 12. But we expect that China is going to do better. And that actually means that maybe the outlook is now, or the impression markets have, is now weaker than actual reality may turn out later this year.
Hans, good morning. The Prime Minister of Poland, Mr. Tusk, speaking for the EU, came up with a phrase, a special place in hell. I would suggest for the EU, the special place in hell is there's no combined fiscal mechanism, and the monetary mechanism is basically unproven. If EU slows down, as we see in Italy, as we see in Germany, as we're going to see in other countries, does the euro have the ability to adjust to help them with the slowdown? Mr. Moscovici speaking right now. Hans, can the EU adjust without the proper tools?
What you're saying is absolutely right, but this is going to launch another mechanism, which I believe people had not adequately debated in the past, namely the pressure to integrate. You cannot run a currency union without political integration. I think that this economic slowdown we are currently seeing is going to force them into additional step of political integration with significant implications on bond markets too.
Can you predict for Morgan Stanley that we will see fiscal integration?
I think that fiscal integration is already starting, and the steps so far have been small, but they are going to accelerate from here. We have a limited amount of time. We do not have safe assets in Europe, or less so than we used to have. That is going to limit the European Central Bank in its possibility to maneuver into the next economic decline. And it is all about to create those safe assets. And I think that you can only do that via political integration.
Hans, I'm looking forward to speaking with Mr. Moscovici about actually the Italian case, but will the Italians have to revise their budget to make up for the slower growth?
I think that this expansionary fiscal policy approach, which had been tried to be implemented earlier, it had always had to have a negative impact given the size of debt in Italy. If you are increasing the funding cost relative to the size of Italian debt, then you have an impact on the economy. We see that. But what we do see too, and we should not underestimate that is the impact on of the tradable goods sector, which is slowing down quite dramatically globally on the Italian economy, which is exposed to it.